Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome in to the weekend edition of the KE Report. On this weekend show, we're going to be taking more of a big picture look at the economy, the U.S. economy, as well as what's going on around the world, central bank policies, how they're influencing some of the recent data and even future data that we're going to be seeing, and then diving into the markets, including commodities, with two of our favorite, more generalist commentators that focus on economic data as well as drive down into the markets. You're going to hear from Jesse Felder as well as Peter Boockvar sharing their insights. I'm sure a lot of similarities and I'm sure also some differences too. So I hope you all enjoy this weekend show, and please keep in touch with us and visit our website and subscribe to our podcast. Just search the KE Report in your podcast player so that you get updates on all our daily editorials and company updates we record from throughout the week. Let's get into this weekend show with Jesse Felder, founder and editor of the Felder Report. Now, Jesse, we took the summer off from chatting, and I'm happy to have you back on to get more of an update, starting with a recent article that you sent out to subscribers. The title simply saying, "What if interest rates are both too low and too high?" This brings up a lot of questions about Fed policy, global central bank policy. Now, when we are in this world where we're seeing some gradual cuts from a lot of central banks, that will tie into, again, what the economy is doing and economic data. So, Jesse, break down that article, what you're pointing out with interest rates potentially being both too low and too high.
Well, I have to give full credit to Bernard Connolly, whose new book I read recently, You Always Hurt the One You Love. And the subtitle of the book is Central Banks and the Murder of Capitalism. It's a long, dense read, but it's very interesting. And he makes the point that the way, this activist monetary policy that we've seen for the last several decades, very aggressive, discretionary monetary policy, has created a situation where you get these huge pull forwards of demand, and then they leave, a vacuum in their wake. And it really kind of screws up the normal capital cycle, the normal economic cycle, and creates these situations where, the Fed is in a very difficult position. And they've increasingly done this through the cycle to kind of get things so, off kilter that it's very difficult to analyze the economy and kind of understand where we're at. And so really the point is that interest rates are possibly too high. And this is kind of where, the argument I was making in the piece this week is that interest rates are essentially too high to allow for a soft landing in the economy. And they're too low to really bring inflation back down to the Fed's target in a sustainable way. And so when you have markets that have now completely priced in a soft landing, and I thought it was very notable to see today, the New York Times publish a piece about how there's a renewed sense of optimism across Wall Street as, the consensus has been that the Fed has achieved a soft landing. When you see that in the mainstream media, it's a lot of times an important sentiment signal. And in that respect, I think there's probably a good possibility that inflation will not come back down to target, that in the short run, it could stay around this current level, but it's likely to head back up to the 3-4% range in a more sustainable way. At the same time, there are signs the economy is slowing significantly and that a soft landing in the economy just may not be possible with the trajectory of the labor market and these types of things. So we might actually get a more stagflationary outcome of persistently elevated inflation and, recessionary type economy.
Well, Jesse, just to that point, let's weave in inflation and interest rates into a discussion about where inflation actually is, because there's a lot of people that if you were using older metrics, the 1980s or 1990s metrics, inflation is still quite a bit higher than it's being reported right now, the way they calculate CPI and the core and the super core. And if you look at where GDP is estimated, some would argue that we're actually still in negative real rates, even though the market is saying when they're looking at the TIPS market that we're in positive real rates. So how do you, balance those out where everyday citizens inflation rates are, if you go to look at food prices or look at fast food prices or look at, what's happening in retail versus what you're seeing on the CPI versus the growth we're seeing. Are we in a negative real rate environment, or are we actually in the positive real rate as it's being reported in the TIPS market?
I think the point I would just make, and this kind of comes back to something Stan Druckenmiller was talking about last week at the Grants conference, is that you have unemployment's very low, the gold price at record highs, stock prices at record highs, corporate spreads at essentially all-time lows. It's very difficult to make the case that monetary policy is significantly restrictive today, which is, as the Fed wants us to believe, that, a 5% foreign change policy rate is above the neutral rate and significantly restrictive. There aren't really any signs in the markets that that policy rate is restrictive. So, but I would just point out, when you're thinking about inflation, the biggest, one of the biggest issues that I have is you look at something like health insurance, right? And according to CPI, health insurance is down 10% or something along those lines over the last couple of years. But then you actually look at health insurance rates, and not only are rates up double digits over the last couple of years, deductibles have also gone up. So if you were to adjust those hedonically, to use a word that the economists like to use, they would be going up even faster than the double digits when you factor in rising deductibles and rising copays and these kinds of things too. So, I think it's a fair argument to be made that CPI doesn't necessarily reflect the reality of inflation. I think, there are measures that come closer. So you mentioned super core inflation, core services less housing is still, I think, 4% plus year over year. And you look at median CPI, essentially what's the middle number? And it's at 3% and change, which means more than half of all the components within CPI are running at above 3% year over year. So, there's a lot of celebration that the Fed has tamed inflation, brought it back down to target. But even if you look beneath the headline measures of inflation, the measures of, the Atlanta Fed sticky price CPI and all of these types of things that kind of measure the persistence, inflation persistence, suggest they're not even close to bringing inflation back to target yet. So I think on the inflation side of things, it's very difficult to make the case that, mission accomplished, inflation is back down to 2% in a sustainable way.
So, Jesse, you made the comment that you think inflation could go back up to the 3-4% region. Look, a lot of things impact inflation: money printing, supply chain disruptions, wages, commodities, China issues. A lot of them tie into each other, and a lot of them have their own little drivers. What do you think are the key drivers moving forward that will move inflation, at least as it's reported, up to that 3 to 4%?
I think the biggest problem for inflation right now is the fact that these other measures that I suggested, core services inflation, essentially, tracks wages in the services economy, are still 4% plus, and that's not coming down. We're actually not even seeing housing inflation kind of come down in the way that most economists and the Fed anticipated. And so that's proving to be stickier than anybody kind of thought it would be. What has driven disinflation over the past, year or two is goods inflation. We've seen goods prices essentially collapse and turn negative, and that has been a very strong deflationary force within the overall CPI. What we saw this last month is that goods inflation or deflation has bottomed out and is starting to reverse higher. And so all of the disinflationary impact that has created is essentially going away. And if that's the case, while services inflation remains sticky, then you're going to see headline measures start to trend back up closer to where services is. So, right now we're 2 and change or something on, headline. We're probably headed back up to 3 and change if goods prices are starting to turn back up again and services is going to remain sticky, which it looks like that is. And so, you just look at the cost of shipping, the cost of, commodities prices and things have kind of bottomed and turned higher recently as part of China stimulus and these types of things. And so there's a lot of things that point to that, renewed inflation in goods. And I think that would be the main driver over the next several months.
Well, Jesse, you brought up rates being too high and too low for different factors. But when you look at the yield curve, it's finally uninverted. After 2 years of being inverted, it's finally steepened on the long end of the curve. So we finally have the 10 above the 2 and the 30 above the 10. So when you look at that, does that give you any pause that often in history, when the yield curve finally uninverts, that's the moment where the contraction in the economy shows up? Is that a concern? And do you think that these rates have been trying to do the Fed's work for them ahead of these rate cuts?
Yeah, I think, that typically is the recession signal when you get the uninversion of the yield curve. And we had a not so good jobs report for August. And then the September report came in and everybody thought, oh my gosh, 250,000 jobs. This is amazing. So maybe the economy is a lot better than expected. But there were a lot of problems with that jobs number. I mean, the seasonality factor was the biggest we've ever seen in history. And that accounted for potentially 100,000 of the 250,000 jobs created. And so there's, and full-time employment continues to decline. Underemployment still really weak. And that's even before you factor in, the revisions to which are inevitably going to come due to things like the birth death model. So, it's amazing how much people focus on, these job reports. The labor market is, classically a lagging economic signal. And so many of these leading economic signals, like the yield curve and like these types of things, point to significant weakness in the labor market. I would just make one point about the bond market, which is that before this backup in yields, the term premium was very, very low on longer term bonds. Essentially, you're getting paid, very, very little for taking long-term interest rate risk at a time when the government is, running massive deficits. And this is one of the reasons, I believe, why two of the greatest investors that I've seen during my career, Warren Buffett and Stan Druckenmiller, are essentially short long bonds at this point in the cycle for the first time in their careers. I mean, Stan Druckenmiller has said he made the vast majority of his profits betting on central bank mistakes, essentially buying bonds in a massively levered way when the economy was slowing down and headed for recession. That he's short bonds today instead of long bonds, says a lot. And Buffett, by the same token, I remember in the very late 90s, the last time he was building up such a massive cash position in Berkshire, not quite as big as he has built up today in terms of the overall percentage of the portfolio. But back then he was, buying zero coupon bonds, essentially betting on falling interest rates. Today, there's no zero coupons in the portfolio. There's no bonds of any duration. He's now the single largest owner of Treasury bills. And so that suggests to me that both Buffett and Druckenmiller are worried about the potential for a real backup in rates, much more significant than what we've seen over the last couple weeks. And so, I think that's another interesting dynamic going on in the markets that not enough people are paid attention to.
So, Jesse, now that we do have the Fed with one rate cut, Canada, I think, has had 3 rate cuts. Other central banks have also been cutting rates outside of what the market is predicting because that market swings so much. What do lower rates do for the economy, for the markets? Are they good? Are they bad? Is everybody on the wrong side of thinking that rate cuts are going to be good across the board?
Well, rate cuts take, just like the rate hikes, right? They take a long time to work through the economy. And that's probably what the Fed is thinking right now, is that if the economy is slowing, they don't want to be behind the curve, because it takes a year or two for those falling interest rates to kind of work their magic on the economy. They need to really try and get ahead of the curve. And so if you look at like the beige book and things that show real significant weakness in the labor market, that's what the Fed is responding to, is saying, hey, look, if typically what happens when the labor market weakens, it doesn't just weaken and then plateau, it accelerates in that direction. And you get, as Bill Dudley put it, kind of a self-reinforcing dynamic where people are afraid of losing their jobs. They spend less. Those companies make less in profit. They need to cut jobs, which makes people worry about their jobs more, and vice versa. All right, so on and so forth. So I think that that's kind of where we're at. The Fed wants to get ahead of that dynamic, and they certainly are now more worried about that side of the mandate than they are on the inflation side of the mandate. Now that sends a very clear message to investors that if the Fed's going to make a mistake, they're going to make a mistake on the inflation side. They'd rather make the mistake of being too supportive of the labor market and allow inflation to pick back up again than they would, be more Paul Volckerish and say, hey, we're going to make sure inflation doesn't come back, even if it costs us a very difficult recession. That, this is the Volcker monetary policy regime, where they're not willing at all to do that. Of course, behind that, the unspoken motivation is not just the labor side of the mandate, but it's also the fact that interest expense for the government is off the chart and it's becoming a problem. So the Fed needs to lower interest rates, not just for the labor market, but also to try and reduce the interest burden on the federal government. So I think that's, the main takeaway investors should have, is that the Fed is determined to miss on the inflation side.
Well, Jesse, let's dive into the general markets a little bit more and merge some of this macro data with it, because when you look at it, the markets themselves have had a fantastic year. Some of that lines up with the last year of a presidential cycle before the changeover in administration, but it's also just been a year of expecting this loosening policy from the central banks to juice the markets, which it has. The markets have been hitting all-time highs, the S&P, the NASDAQ, and it's not just the mega cap tech stocks now. It has broadened out in breadth into some other sectors like the value sector, the healthcare, the financials, REITs, and we've even seen some of the small caps get a bid. Where are we at in this cycle? Are we at the end of a cycle here? Are we in a new bull market cycle? Are we at risk of a market correction? Where do you think we are relative to the U.S. equity markets?
Well, if there's one indicator, macro indicator, that I could have and get rid of all the rest, if I could only have one, it would be the aggregate activity of insiders in their own shares. So what are the leaders of corporate America doing with their own money in the stock market? And that right now, in aggregate, insiders are more bearish than they've ever been in at least a decade. The total 12-month sell to buy ratio has only been this high in November, as it is today, in November of 2021. That was a very clear message about, where the market and earnings were headed over the next 12 to 24 months. And we saw a painful bear market in 2022, right in the wake of that activity. But I would just point out too that the actual insight, it's not just selling that's driving this. And we've seen, literally last quarter was the most selling by semiconductor insiders in history. Right. And so semiconductors have been one of these momentum trades driving the market higher, led by NVIDIA. We've never seen so much insider selling as we did last quarter in that sector. But it's really lack of buying that is really, I think, the biggest problem right now, or the clearest message from insiders. In 12-month insider buying fell to a level we haven't seen since 2012. And so for insiders to be buying less stock than they have in over a decade is a very clear message that they see no reason to take risk in the equity market right now, that valuations aren't compelling. And, when you take that total buying and compare it to market cap, it's literally the least amount of insider buying we've ever seen in the history of the data that I've looked at. And so to me, that's a very clear message from the leaders of corporate America, that they do not think that the economy and earnings and stock prices are going to meet expectations over the next 1 to 2 years.
Man, it has just been a crazy run for these markets. The S&P, I think, is up 10 out of the last 11 months, and, well, it's done pretty well this month, too. This year, the S&P is up 20%. Last year, it was up 25%. Jesse, what's driven this move then? Is it all just everyone accepting rate cuts? Is it the whole no other options for investors, even though they can get some returns in money market funds, but those are drastically lagging? Why have these markets been so strong?
Well, I think it's animal spirits. I think that's the only thing you can really attribute it to, because there are alternatives. As John Authers pointed out yesterday in his piece for Bloomberg, the 10-year Treasury yield is now above the earnings yield of the S&P 500 for the first time in 22 years. So first time in 22 years, bonds now offer a greater yield than stocks in terms of earnings yield. I don't think that's a wonderful way to compare, the two asset classes. But you still get 5% on T-bills today, or close to it. So there are alternatives out there. I think it's just that investors are so enamored of the stock market that they continue to pour money into passive vehicles, right? We've seen this year, I think we've already broken records for money going into the big Vanguard and BlackRock total market S&P 500 index funds. A lot of that is just, 401k kind of stuff, automatic, with withdrawals from paychecks that just go straight into the market. But also you look at the allocation, that households, investors have put in the equity market. It's just the highest, that it's ever been. It's essentially matched with March of 2000, first quarter of 2000, where 48% of household assets are allocated to the stock market. It's never been higher than that. And so, you have that dynamic, the passive dynamic. And then I think there's a third dynamic too, which is just, a purely speculative element. We've seen so much money go into 0 day to expiry call options, into longer term call options for things like NVIDIA. I mean, NVIDIA dominates the options market every day. There's just tons of money, being people buying calls. And for a while it was Tesla. And, sometimes it's Apple. And it just rotates among those magnificent 7 companies, whichever one's hot. There's just, like moths to a flame, and people going into the options markets. And then there's leveraged ETFs, right? People point out and say, well, margin debt isn't that high. Well, why would you take on margin debt when interest rates are the highest in 20 years? It makes no sense. But a leveraged ETF, right? I don't have to pay interest. I can buy, and literally a 2 times or 3x NVIDIA ETF, and I don't have to take on any margin debt. They have that for, QQQ, levered to the upside. The assets in leveraged ETFs are also at record highs. I mean, tens of billions of dollars poured into these leveraged vehicles. So I think that is really kind of what explains it. And it's driven by this soft landing narrative that the Fed has pulled off a soft landing. So, it's very much like the Dick Fold Lehman quote, while the music's still playing, we're going to keep dancing. And that's what investors are doing, is they're continuing to speculate as long as the market can levitate. And I think we're very closely nearing that time where it's not going to be able to levitate much longer.
Yeah, Jesse, they are definitely back with the speculative fervor. And like you're saying, the options market indicate that, but also the use of those 2 times, 3 times ETFs to get that extra leverage. But when you look at that, it's a weird backdrop to see gold, which is usually considered a safe haven or defensive element, doing so well in tandem with recently a rising dollar, but also with the markets doing so well. What do you make of the strength of gold in an environment where people are so happy to speculate?
Well, it's interesting to me. I mean, it's been amazing to me to see, S&P 500 up 20% this year, gold up 30% this year. And the former garners all kinds of interest and headlines, and the interest in gold is totally just not there. You look at the number of, it's one thing I track in Bloomberg, is the number of articles that mention gold, and it's still, on the floor. There, you look at the assets in ETFs, and there's just no interest. But there are obviously, drivers taking the price to highs at central banks around the world. And there's something that these central banks around the world clearly realize that Western investors have not figured out yet. And that's, it's not so much gold rising as currencies declining in value versus, stable type of asset like the gold price. And I think that really is the best way to characterize it. Is, we were just talking about inflation, right? The purchasing power of the dollar has declined dramatically over the last few years. That's now just beginning to be reflected in the gold price. And so, there's a lot of central banks around the world that say, hey, look, we don't want to be so heavily allocated, dependent upon dollars, for national security reasons, but also for the reason that it looks like, and this is very much related to what I mentioned earlier about the bond market with Buffett and Druckenmiller not wanting to own long-term treasuries, is that we're very clearly headed for some type of a fiscal, I don't want to use too strong of a term, but some type of a fiscal problem where potentially, if we were to go into recession and see revenues, I'm talking tax revenues, decline as they normally do in recession and blow out the deficit even further than it is, you could really see some problems in the bond market, because that would mean supply has to, increase dramatically at a time when there really isn't enough potential demand in the bond market to kind of soak it all up. So I think there are a lot of reasons out there, but mainly it's that the fiscal profligacy is accelerating right now. You look at both of the presidential candidates, and they're both trying to outdo each other in terms of that profligacy. So, it's not an encouraging message for bondholders. And so I think that's what is really driving the gold price. I think as that narrative becomes a little bit more well understood by Western investors, we're going to finally see that money start coming back into gold ETFs and things in a big way.
So, Jesse, yes, gold has done very well. We've even started to see some significant inflows into the gold ETFs. Silver has started to do well too, and the gold stocks have done decently, but they're arguably not outperforming the way that investors would like to see when you see the rest of the market doing so well as well. So, what's it going to take for silver to get back up potentially to those all-time highs and for gold stocks to really start outperforming?
Well, I think silver is pretty darn cheap relative to the gold price. I think we're at that point. In the short run, I think, we have some potential for more just kind of seasonal weakness here in the precious metals over the next month or maybe two. I say that from a seasonal perspective, but also from, where we are in the monetary cycle. If you look back at the last cycle, we're kind of in that stage where Jay Powell pivoted in late 18, early 19, and then it wasn't until kind of late 19 that we had the repo fiasco, and that really kicked, gold into a higher gear. I think we're kind of waiting. We're in that in-between period where, yes, the central bank has pivoted, but we might need to wait for something to break in the financial plumbing before you really get that next strong leg higher in precious metals. I think it's probably coming. I don't know where it's going to come from, but it seems to rise up in every cycle, every monetary cycle. We see this. And so I think we're headed for that time. So in the very short run, we could get some more consolidation in the precious metals, but we're headed for a time where I do think the Fed is going to have to respond to some type of plumbing or something going wrong in the financial markets. And that will be the trigger for the next leg higher in the markets, along with probably, more interest rate cuts. At that time, that's when you're going to see, I think, silver and the miners lead to the upside, because that's when you're going to get those Western investors saying, hey, look, this is the time to get involved. And they're going to be the ones who really drive that push. And typically that, you see that not just go into the gold price, but it goes into those higher beta things like silver and the miners.
Well, Jesse, I know you also follow the energy sector pretty closely, and it's a big component of inflation. It's a big component of what kind of discretionary income consumers have. It affects the business and the freight and, all parts of the society. What is your outlook on oil and nat gas and the energy stocks? Because they're always on a wild roller coaster ride, but there's a lot of people on both camps, the bull and the bear camp. How are you looking at the energy space?
Well, for the past, 6 months or so, I've been saying that, the two most hated asset classes on the planet, number one and number two, were Chinese equities and energy stocks. And obviously, Chinese equities aren't that hated anymore. They had a huge pop recently. They're giving some of that back lately, but I think that leaves now the energy sector, the energy space, as the most hated asset class on the planet. And I think that's not necessarily deserved. I mentioned Buffett earlier. The only thing, he's been selling Apple significantly. He's been selling down his Bank of America stake. As I said, he's avoiding long-term Treasury bonds. But what has he been buying? He's been buying Occidental Petroleum. It's really the only significant purchases that he's been making over the past year or two. But you also look at like Carlos Slim doing the same thing. PBF Energy, a big refiner. One of the Mexican billionaire who's been buying literally almost in the market every day, buying some energy stocks. Another one that I've been looking at, Jerry Jones owns about 70% of the Comstock Energy outstanding shares. He just made some recent big purchases in Comstock. And then the founder of Fortress Capital, big private equity firm, has been buying New Fortress Energy. So it's literally the only insider buying of note that I see is in the energy space. And energy stocks today, as my friend Callum Thomas pointed out, are essentially as cheap as they've ever been relative to the broad market. I think they're a very interesting contrarian play. They're a value play. And what's, I think, most interesting about them in terms of a timing perspective is that the oil price typically bottoms right, just like the yield curve inverts or uninverts right at the start of recession. The oil price bottoms right at the start of recession and begins to anticipate fiscal stimulus. And so oil price starts going up. There's potentially, we've seen both of those things happen at the same time. Oil prices bottom and the yield curve uninvert at the same time. That could have been the signal that recession has started. If so, we'll start hearing more about potential stimulus to support not just rate cuts, but maybe potentially on the fiscal side as well to try and address a recessionary economy. If that's the case, I mean, we're already seeing it massively in China, and that will continue. And that's part of one of the reasons why oil price, has done what it's done. If China continues and we see the rest of the world kind of come around to that stimulative view, we're going to see oil prices bottom and trend significantly higher over the next few years.
So what about some of these other energy sources then? Some of the greener energy sources like wind, solar, and even mixing in nuclear. Man, we've heard a lot more news in the uranium and nuclear sector. So where do you stand on some of these other cleaner energy sources?
I think we've seen tons of them, built out recently, and I think it's difficult to make money on them. I think because, as my friends at Gehring and Rosenzweig have pointed out, we've never seen an energy transition that moves to a less efficient form of energy, which is what all of these things are. They're intermittent, they're not consistent, and they don't produce a return on investment anywhere near what fossil fuels or nuclear produces. And so, there are obviously environmental reasons and climate change reasons to make these investments, but as from an investor's standpoint, I don't think they make a great deal of sense. I think in the very short run, I'm very intrigued by natural gas. I think it's been really cheap, just like silver's cheap relative to gold. Natural gas is cheap relative to the oil price. And there's a huge opportunity. I mean, this is one of the stocks I mentioned, New Fortress Energy, is getting involved in shipping liquid natural gas overseas. They can buy it for $2 here, sell it in Europe for $12, make a $7 spread. In the very short run, I think natural gas is a very interesting transitional fuel where we can bring on natural gas power plants much, much more quickly than we can bring on nuclear or anything else. Actually, New Fortress has a model that they built out in Puerto Rico as an emergency system where they can bring a new natural gas plant online in 120 days, which is a lot faster than 3 to 5 years than is in the case for most power generation. And so I think natural gas is very interesting right now.
Well, Jesse, just as we look at the rest of the commodities complex, a lot of it is in the eye of China and the Chinese economy because they're such a huge manufacturing hub. They're such a huge engine of growth. They're such a huge engine of using all things commodities. When you look at things like copper or other base metals, what do you think the lay of the land is in relation to if we're going to have that hard or soft landing?
Well, I think that we're definitely headed. I personally think we're headed for a hard landing, and we're probably already there. To me, that New York Times article today that essentially celebrated the arrival of the soft landing, and I've seen a few of them over the last couple of weeks, are that almost the exact same kind of magazine cover indicator that we saw from Bloomberg in 2019, the death of inflation and these types of things. As soon as people kind of celebrate something, it's usually a sign that that they're dead wrong. And I don't wish for a hard landing in the economy, but I think that it's an inevitable outcome from the mistakes the Fed made during COVID, massively overstimulating, creating a huge inflation problem, being very late behind the curve to deal with it, and then having to do a rapid 180 in terms of monetary policy. To me, all of the signs already suggest that there's a good chance we're already in recession, and if not, it's likely going to be here very soon. Now, from a commodities standpoint, as I said, China has already been in recession for a long time. They're already in stimulation mode, and they're the biggest consumers of commodities. So from a commodity standpoint, I think it's very bullish that China is already trying to, stimulate their economy, and that should be bullish for commodities. And as I said, too, typically what you see in the oil price, and the commodities markets generally are the oil price, is that it bottoms right at the start of a recession. And so I think, this bottom that we've seen in oil prices over the last month or two could be that signal that recession has begun, and oil prices going to start is in the process of bottoming in reaction to the global shift in monetary and fiscal policy that is already underway globally.
All right, Jesse, we'll wrap it up here, but we're going to be following up with you in the upcoming months and into next year to see how this more or less recession call plays out, what the economy does, and where the markets go from here. I hope everybody enjoyed this conversation with Jesse Felder. Everyone stick around. We are going to be right back, continuing our discussion on where the economy lies and where the market lies. Jesse, thank you for your time.
Thanks, guys. Always great to talk with you.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. And look, as promised on this weekend show, we're getting two differing opinions on the economy, the markets, and interest rate policy, not just in the U.S., but around the world. You all heard from Jesse Felder in the first segment. Now it's time to switch our focus over with Peter Boockvar, Chief Investment Officer at Bleakley Financial Group and also editor of the Boock Report on Substack. I will post a link to that report in the show notes. I highly recommend signing up for the Boock Report if you want to keep up to date really on a daily basis with key economic data, key market news, key earnings recaps. Peter really covers it all as that news comes out and is released throughout the day. It's a lot of information, but it is my go-to source every morning to get caught up on what some of the economic data has been and where the markets are moving. So, Peter, let's get right into it then. Let's hear your assessment of the overall health of the U.S. economy. The data seems to be hanging in fairly well, but you can point to certain areas that have been in contraction. The economy isn't growing as strong as it was, let's say, a year ago, but it's also not in negative territory. So, Peter, your overall assessment of the U.S. economy right now, please.
Well, I think it's important to break it out rather than giving one overall opinion. I've been referring to the overall opinion as being mixed and uneven, the economy, rather than saying it's good or it's bad or it's not, it's in the middle. You have pockets of strength, you have pockets of weakness. Pockets of strength are related to an enormous amount of government spending and the beneficiaries of that spend, whether you're in the healthcare business or you're receiving higher interest income relative to pre-2022 levels, or you're building a semiconductor plant in Arizona, or you're building an EV battery plant in Kansas. Those that are benefiting from that government spend, that's the area of the economy that's doing pretty well. If you are involved in anything to do with AI and a beneficiary of the enormous amount of capital spending in that area, you're doing well. But if, on the other hand, if you're in other parts of technology like selling smartphones or PCs, your business is more challenged. If you are a lower to middle income consumer, the spending outlook is much more cautious. People are much more value seeking. They're being much more discriminating with how they spend their money. If you're in manufacturing, there's a recession going on, and it's been going on for about 2 years. If you're in the housing sector, if you're a real estate agent selling existing homes, business is probably pretty tough because there's not that much inventory and there are affordability issues that many people are facing. If you are in the new build market, working for a bigger home builder, well, then business is probably okay building out communities because the market needs more product. So it's very bifurcated, a lot of mixed signals that I think sort of clouds anybody looking at what headline GDP tells you.
Yeah, Peter, it really takes a nuanced view because there are the pockets of strength, pockets of weakness, as you outlined. Maybe want to dig into a couple of those that you mentioned. I guess first off is the manufacturing having been in what some would dub recessionary territory the last couple of years. It kind of speaks to a larger theme that we don't necessarily have to have a recession that wipes out everything it could actually be pockets of recession and pockets of growth. So maybe just speak to the manufacturing sector and how that differs than some of the other sectors like an AI sector.
Well, manufacturing is a couple of things, and it's not just in the U.S., it's globally. And we all know that people spent a lot of money on stuff in COVID and coming out of COVID and then shifted their spend to other things. So there's basically a hangover from that. I mean, if you put in a deck in 2020 and 2021, well, you're not going to put in a deck soon after in 2024. You're going to wait a long time, if at all, to do it again. So I think there's that hangover effect, and that's one of the main reasons. Also, I think it was going into 2022, there were a lot of retailers that were worried about the supply chains, and they all stocked up on too much inventory in 2022. And going into 2023, we're left with too much stuff. And I think that, at least on the retail side, particularly the bigger ones, have been much more diligent and disciplined in trying to keep some lean inventories. And then, of course, you have higher interest rates. And for some stuff, whether it's high-cost items like a home or a car or even, an expensive TV that you get at Best Buy, chances are for some people or many people, you're going to be financing it. Financing costs have obviously gone up a lot, and that's also crimping the demand for manufactured goods. So I think that's all combining for the recession we're seeing in that particular area of the global economy.
Peter, what's your assessment on inflation? We keep on hearing that inflation is going to remain sticky above that 2% level. Some people are even saying that inflation runs higher to 3, 4, maybe even back to 5%. Where do you see inflation playing out, and what do you see the major drivers being?
Well, on the good side, which is where we've seen the most amount of disinflation, we'll have to see. I think, there's possibility that we start to bottom out. And I say that for a couple of reasons. Number one, if China is successful in just at least stabilizing their economy, I don't think they're looking to necessarily stimulate their economy. I'm thinking they're looking to stabilize, particularly their housing market. That's their biggest priority. So maybe that's one factor. At some point, maybe this manufacturing recession ends and you start to get some inventory rebuild. That could, draw a line under the goods deflation we've seen. So that's just one thing I'm watching. On the services side, rental increases will continue to slow. So we'll get deflationary pressures on the service side in the early part into the middle part of next year. But I think we're sowing the seeds for reacceleration in rents that will show up in services inflation at some point in 2026. I think my real belief with inflation is we're not just magically going back to 1% to 2% and staying there. I think we're in a new world of inflation volatility. And, if you look at the TIPS market, at least over the next 5 years, TIPS are saying, okay, inflation is going to average a little more than 2%. I think that's overly generous. And I think that something around 3-ish or more is where inflation will eventually settle out at. Obviously, there's an election here in a couple of weeks. We'll see who wins and what sort of tariffs we're all going to get, which will be inflationary also, as it raises the taxes on a variety of different goods that companies will try their best to pass on to the rest of us, in addition to whether this government spending continues on this extraordinarily dangerous path, which is itself inflationary because it's just throwing money that we don't have onto the economy via borrowing, and that itself can potentially be inflationary as well.
Well, Peter, just to that point you just made, I think a lot of people, when they classically think about where inflation comes from, it's an increase in the money supply, and it's a lot of, I guess, out of control fiscal spending from the government side, but also the monetary policy of central banks. Is that more germane, or are these, I guess, goods and service issues, and then also, possibly increases in energy, things like oil, if it has another tick up, are those more germane? Where is the inflation coming from if it is stickier and it stays around longer?
Well, I mentioned China. I mentioned the possibility of at some point this manufacturing recession is going to end. I do have my eyes very closely on commodity prices to see how they respond to what China announced, in addition to how the geopolitics are playing out with the price of oil. So we'll have to see. I mean, historically, there is no goods inflation. Historically, because of technology and production efficiencies and so on, there isn't any goods inflation. It's usually on the services side that tends to drive non-transitory inflation. So, a few things that I'm watching at it, but look at PPI in the U.S. PPI in the U.S. is still remaining around 2-ish%. It's not falling into disinflation. So we have to keep our eye on that. We've seen a very sharp rise in transportation costs. If you look at container shipping prices, they've been on a roller coaster, but they're still more than almost triple where they started the year. If you look at the World Container Index, looking at the Shanghai to Rotterdam or Shanghai to LA or Shanghai to New York routes, the shipping costs, while they're off their summer highs, they're up a lot from the beginning of the year. And what's happened was, even with the strike, is there's been a lot of shifting of goods deliveries ahead of the holidays into air cargo. Air cargo prices have jumped a lot. So there are pockets of stickiness. And then on the services side, you still have higher labor costs, which not everyone can pass through can absorb via productivity gains. A lot of times they can't. If you're a restaurant, if you own 2 restaurants, you don't have all these productivity levers to pull. And if wage costs are going up, chances are you're going to raise menu prices in order to recapture that. So I still think that there's some underlying bid to inflation. A lot of it is government spending induced. And if the Fed gets too cute here with cutting interest rates, then that can stoke even potentially more demand for goods where people are borrowing money. If they can borrow it cheaper, then they're more inclined to make a purchase of a good. So these are the different things that I'm paying attention to. I'm still, I'm not confident on where we settle out in inflation. I'm more confident that it's going to happen closer to 3 rather than 2.
Let's talk about interest rate cuts then, because that is the trend right now. The U.S. came out with a 50 basis point cut. Canada's been cutting. The ECB's been cutting. China's been the most aggressive out there. They're in full-on stimulus mode, even though they're not calling it that. How do these rate cuts, in your eyes, play through the system, economy-wise and market-wise?
Well, what's been most interesting is that even before the Fed cut, the market had already priced in more than 200 basis points of rate cuts. Right before the upside surprise in the September payroll number, the December 2025 Fed funds futures contract was yielding 2.9% from an effective rate before the rate cut of 5.33%. So we had priced in a lot. Now that December 2025 contract is closer to 330 instead of 290. But now that the Fed said, hey, let's cut 50 instead of 25, in addition to the China news, in addition to the good payroll number, in addition to the upside in the CPI that we just got, rates have done nothing but go straight up. So the Fed actually shot themselves in the foot by cutting 50 because the market then immediately took away 50 basis points of cuts. They're obviously still expecting a bunch of cuts through the end of next year, but they definitely took away some of them. And I think it was, a sign that the Fed's going to have to tread very gingerly here. I've been thinking, at least for now, that we're on the cusp of not a broad rate cutting cycle, but more of a rate tweaking cycle. And we heard from voting members Mary Daly, Raphael Bostic, Chris Waller, who also alluded to that whereas a few weeks ago the market was saying they'll cut another 25 in November, another 25 in December, now there's a possibility maybe there's only one more 25 basis point cut by the end of the year. So I just think that markets are just too believing of that. Okay, the economy softens, Fed has all this flexibility, this huge ability to just respond to anything that comes our way with rate cuts. And I just think it's going to be more complicated than that. I don't think they're going to have the same level of flexibility. I think that, inflation and the data and the government spending is going to be okay enough that rates are going to stay sticky around these levels, I believe.
Well, Peter, when you look at the interest rates and the path of them, the yield curve has uninverted now and then it's steepened at the long end of the curve and normalized a bit. Do you think it's the inverse of the bond market action? So do you think that these markets are reacting, and bonds in general are reacting to the Fed rate cutting cycle and trying to get in front of that, and that's why they moved ahead of the Fed? Or do you think that they're reacting to the strength of the bond auctions themselves? I know that you put out a lot of research on the strength of the various time-oriented treasuries and how those bond auctions are going. What trends are you seeing in that department?
The auctions, interestingly, have, there was a long string of poor auctions, particularly as the Fed was raising interest rates, and they've gotten more selectively better. But I think the general trend, though, with auctions, with the Treasury market generally, is foreigners, while they continue to buy, even though you have to sort of differentiate foreigners because Cayman Islands falls under foreigners, and those aren't natural. Those are more hedge funds, but they're buying less as a percentage of total issuance. The U.S. budget deficit is essentially being mostly financed by the U.S. private sector, whether it's individuals, whether it's pension funds or insurance companies, and so on, and less so foreigners. So that means that we don't have the same sort of help that we used to, and also the Fed, which is no longer financing it either, at least for now, via QT. So, with the auctions, it's a good sentiment gauge on that particular day that it's issued, but the carry forward is more going to be responding to expectations for growth and inflation and what the Fed is going to do. But I do think that there's going to be an underlying sort of bid to the longer end yield as gold continues to trade higher, and people do seem to be questioning U.S. debts and deficits now more so than ever, particularly with the 6% GDP or a budget deficit relative to GDP and a 4% unemployment environment, which I don't think has ever been seen before. So I think this is all combining for, like I said, sort of a bid to underneath longer end bond yields.
What about the bid that we've seen in the markets, too? A lot of the naysayers, the bears out there, were saying that there wasn't any breadth out there. It was being led by the Magnificent Seven, the AI movement. We've seen a pullback in a lot of the Magnificent Seven stocks and some of the AI stocks as well, but we've seen a broadening out. You look at the equal weight S&P, that recently was at all-time highs. What do you make of this market where, look, gold's doing well, markets are doing well? Where is this market in your eyes?
A couple of things. So I think we started to get a change in complexion in early to mid-July when the market absorbed all the tech earnings, particularly the AI-related tech companies, Microsoft and Google and Amazon and so forth. And I think what started to happen was, because up to that point, if you just said the word AI, your stock rallied. If you spent a lot of money on AI, your stock rallied. If you got that spend, like NVIDIA, obviously your stock rallied because they directly reflected an increase in revenue. But after Q2 earnings, the market started to say, okay, well, we have the spenders on AI and they're spending gobs of money. And, what's the payoff for that? And then on the other hand, who's getting that money? And I think the market sort of switched to who's getting that money. And we started to see some sort of differentiation and some questions being asked on all this AI spend and what are the benefits going to be and so forth. And I think since then, we've seen a nice broadening out of the market to other things outside of those names. So the S&P 493 finally got some love, as did mid caps and small caps, deservingly so, because a lot of them got cheap and a lot of them have so dramatically underperformed the big names that it was due for some mean reversion. Also, some foreign markets, and particularly China, just over the past month, also got finally some love as well. So I think that's, on one hand, that's a healthy thing. But on the other hand, if you lose that big cap tech leadership, you have to ask yourself is who's going to, on a sustainable basis, pick up the baton.
Well, one area of focus in the markets that has gotten some of that love that was ignored before has kind of been the value sector, Peter. We've seen things like healthcare or REITs or utilities, and to that point, precious metals also get a bid. Is that just because everything's widening out and so all sectors are getting a bid, or is it because some of those are interest rate sensitive? Why the move into value stocks while growth tech stocks are also still rallying to some degree? It seems like it's an everything rally, or is there something else going on under the surface?
Well, it didn't start out as an everything rally. As I mentioned, there was a rotation or a shift out of those big cap tech stocks into other things. And the NASDAQ, at least through August, September, really underperformed. It's only recently with NVIDIA and Apple today, and Meta has traded well. So those have played some catch up. But outside of that, with Google and Tesla, even Microsoft is well below its highs. But it was related to that shift, but also the Fed in market pricing in a lot of rate cuts, small, medium-sized businesses, they were most negatively impacted by the sharp rise in interest rates. And, they're going to benefit if rates stay at least where they are, or the Fed continues to cut on the shorter end, depending on where in the curve you borrow, but a lot of these smaller companies borrow SOFR plus, and if SOFR falls because the Fed's cutting short-term interest rates, then they can benefit from that. So I think that also was a help to at least that part of the market and value stocks generally.
So, Peter, is this a time in the market where investors can still be relatively aggressive, have a lot of money at work, other than taking strictly, I guess, cash positions, putting their money in money market funds just to earn a yield?
Well, money markets obviously paying you a nice yield. This stock market rally has really been, since the early part of the year, has really been driven by PE ratio expansion. There's been very little change in earnings expectations. In fact, they're slightly down. So this is talking about going from a high teens multiple to a low 20s multiple. And, 22 times earnings with, 4% earnings growth expected for this quarter, with rates staying up and the Fed maybe not being able to cut interest rates as much as the market thought. I think, anybody who focuses on valuation, and we know I say that because somewhat sarcastically, because we know there's people in the market that are very agnostic when it comes to inflation. They're just focused on the story. That I still think, you're trading at these valuations with the Fed not being so friendly. I don't think as the market is priced in, inflation remaining sticky, so and so on, labor markets being, softening up, that I think people just have to be careful and just have eyes wide open. Right now they don't. We have seemingly everyone all in. We have households that are all in, and everyone thinking that whatever comes our way, the Fed's going to be able to save us from. That I do think that there's a level of complacency out there that people should just be aware of.
Well, a lot of people we've asked about the valuations, Peter, over the last really year or two, or couple years, and a lot of people have said the valuations don't matter until they matter. So it seems like they are starting to matter more to investors, and they are starting to look at where things are priced versus their earnings. It brings up a good point about gold and the gold equities. We've mentioned several times in this call that gold has done well, and it's had a banner year. It's outperformed the equities, to the U.S. equities to a great extent, up over 30%. But the gold equities themselves haven't fared that well, but they have the fattest margins they've ever had for the quarter we just saw. Will better earnings in gold equity producers finally get attention from the Wall Street crowd that maybe has been ignoring the sector but can't ignore that earnings growth forever?
So I think so. I hope so. I think that we have reached a point, and to your point about fat margins, I think this earnings season is going to be very interesting when it comes to that, and whether companies can fully benefit from that rise in price. If you look at Barrick Gold, who gave some, just some production numbers, not their full earnings, gold's up 0.5% and the stock is trading down. So I think just people have gotten so burned by owning these things over the years that it's more of a show me the money type mentality. But hopefully this quarterly earnings season in the metals, they will finally show investors the money. And if that's the case, then I think that these stocks will finally get more re-rated relative to where the price of gold is, rather than this taint of sort of apathy and disgust towards them, where they've disappointed investors for so long.
Barrick's a good example too, because look, they're going to be earning better margins on their production, but their production, I think, has been falling year over year. So when you look at maybe gold miners, do you think the market wants to see more growth just in terms of production outside of the underlying metals price moving higher?
Well, on one hand, yes, investors always love to see growth. On the other hand, if you're a sort of a generalist investor and you want to get exposure to the gold mining group, you'll buy an ETF, or you'll buy the biggest names like Newmont, Barrick, or Agnico, even though they're obviously also the biggest components of the ETFs too. So you're essentially buying those same names. So, Barrick will benefit from that. Barrick's still an interesting name. I'm not necessarily trying to pull out Barrick as its own situation, but I think this is the quarter that these stocks finally get rewarded. And I guess that's the message, that if you're a CEO in this kind of environment, you better deliver at this point. Because if it's not now, I don't know when it'll ever be.
Yeah, great point, Peter. If they can't make money at these prices, then there's bigger problems going on under the surface. Well, let's also shift over to the energy sector. A lot of interest in what's going on with the need for energy and more electricity to feed AI and to feed EVs and to feed the green initiatives. but not so much action in a lot of the energy sector, but it's been volatile in oil and nat gas. How are you looking at energy?
So we've been bullish and long energy stocks for years now. And, right now it's kind of an interesting dynamic where, I've been very bullish at least on the oil side on the supply situation where, inventories are somewhat low and that is sort of a support. But now we're dealing with worries about the demand side and China slowing and so on. And then you throw in, of course, all the geopolitics, but there hasn't been any disruptions at all to the delivery of oil, and therefore there really hasn't been any much of a geopolitical premium in it. But I do think that oil prices are still going to hover around $70 to $90 in the next couple of years, and a lot of companies in this industry are going to do pretty well with that. I've been very bullish on natural gas, even though the price is languished, because I think the demand side is just so tremendous, but supply side is as well, and why natural gas is in the 2-ish range in the U.S. But I do think that the natural gas stocks, particularly on the midstream business, which is obviously less exposed to the vagaries of drilling and the actual price more focused on volume, that the demand for global natural gas is high. Pipeline companies are very interesting in that kind of environment. Commodities outside of that, I know you asked about energy, but that's my feeling with energy. And I'll throw uranium into that energy basket because I've been bullish and long uranium for years now, and I think the story just gets ever more exciting, which on the other hand means that, you got to start thinking about, if everyone is so excited, when's the time to exit this trade? And that's the point I'm trying to figure out now that it's become more of the daily news, particularly when you have Microsoft and Google and Amazon all talking about tapping into the nuclear grid, whether it's now with 3 Mile Island or over the coming years and by 2030 in the SMRs, that you wonder if, when everyone loves uranium, it may be time to sell, even though at $82 a pound, to me still seems pretty cheap.
Yeah, uranium has done well. 2023, a good year. 2024 started off well. We went through a bit of a drop, but boy, oh boy, that rebound has been quick. Peter, any other commodities? Copper gets talked about a lot. Any of the other, let's call them energy metals or critical minerals that have your attention that you see an opportunity in?
I mean, copper is definitely interesting. I mean, we have some of that exposure via some of the gold stocks we own. I still wonder the demand side from China. So that has I know all the electrification bull case for sure. It's definitely interesting. Copper prices are going to remain wealthy for sure. The area of commodities that is really more exciting to me right now is not necessarily big picture, but at least now is agriculture, with corn prices depressed, with soybean prices depressed, with fertilizer prices depressed. I like to buy commodities when they're depressed. And so we like some of the fertilizer names like Mosaic and Nutrien that we had owned before the Russian invasion of Ukraine and sold when prices spiked upon that invasion. And now those stocks are basically right back down again. And I like to buy things when a company is on the downside of a cycle, still generating good cash flow and paying good dividends. I think that's usually some margin of safety built in, that I can't tell you the timing when corn and soybean prices go back up again and fertilizer prices follow. But I think you're getting definitely compensated for the risk that you take buying it around these levels.
Well, Peter, one other segment of the market that we haven't talked about in a while is the cryptoverse. It's kind of a different market outside of U.S. equities and outside of the commodity space. How are you looking at things like Bitcoin, Ethereum, or any of the other altcoins?
Well, it's interesting. Bitcoin is trading very well right now. And I'm not sure why, maybe other than just maybe an election bet on who's going to be more supportive for Bitcoin. I still think that while I sympathize with the bull case on Bitcoin because, hey, I'm long gold, I still think that Bitcoin needs to prove itself in terms of separating itself from being highly correlated to the NASDAQ 100. I think it needs to sort of trade on its own factors and not just be the speculative NASDAQ-like instrument. And to me, it hasn't yet proven itself in that way. It may will. I'm not making a judgment whether it is or it's not from here, but I think up to this point, it pretty much has. And I'd like to see some separation so Bitcoin can trade more like gold rather than NVIDIA.
All right. Peter Boockvar, Chief Investment Officer at Bleakley Financial Group, also editor of the Boock Report on Substack. Again, click that link in the show notes to visit Peter's book report and sign up for it. It is well worth your time. Peter, we're going to be seeing you at the New Orleans Investment Conference starting November 20th this year. Hopefully a lot of our listeners will be able to join us. Please, everybody, send us a line if you are heading out there, and we're happy to set up a time to chat with you, walk around the conference, even grab a drink. We had a couple different opinions and a couple similarities here on the economy, the markets, and commodities. I hope you all enjoyed this weekend show, and please remember to go back through our website, kereport.com, and subscribe to our podcast. Just search The KE Report in your podcast player to be up to date on all our daily editorials and company updates, as well as our weekend show. Everybody, thank you for tuning in to this weekend show. And Peter, again, thank you very much for your time this weekend.
Great chatting with you guys. See you soon.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.